Imagine this. It's December 29, 1989. You're standing in Tokyo's Ginza district, surrounded by the richest people on earth. Champagne flows like water. The Nikkei just hit 38,915, an all-time high. Businessmen in sharp suits are celebrating like they've discovered the secret to infinite wealth. And maybe they have. Because here's what's actually happening. The land beneath the Imperial Palace in Tokyo is now theoretically worth more than the entire state of California. A single golf club membership is trading for $3 million. Japanese companies aren't even pretending to make money from products anymore. 40% of corporate earnings come from playing the stock market, not building cars or selling electronics. Japan isn't just rich. It's so absurdly, impossibly wealthy that economists are seriously asking when, not if, it will overtake the United States as the world's largest economy. Now fast forward to today. Japan's government debt is 237% of GDP. That's $13 trillion. The highest debt burden of any developed nation on earth. Greece nearly imploded at 180%. Italy is sweating at 140%. The United States, even after printing money like it's going out of style, sits at 120%. And yet Japan? Japan is fine. Bond yields are under 1%. There's no panic. No hyperinflation. No mass capital flight. The trains still run on time. The economy just functions. So what the absolute hell is going on? This isn't a story about smart fiscal policy. This is a story about how the greatest economic bubble in human history exploded so violently that the government had no choice but to trap itself in a debt prison just to keep the lights on. And now, 3 decades later, they can't escape even if they wanted to. This is the paradox of Japanese debt. And it starts with the most spectacular financial catastrophe you've never heard of. To understand how Japan ended up here, you need to understand the economic mania that came before. A bubble so massive it makes 2008 look like a bad weekend in Vegas. In the early 1980s, Japan was unstoppable. Sony, Toyota, Honda, Panasonic. Japanese brands were conquering the world. The country ran massive trade surpluses. Manufacturing efficiency was the envy of every nation. By the mid-1980s, Japan had become the world's largest creditor nation. But this success pissed off the Americans. U.S. automakers were getting demolished. Steel mills were closing. Factories were hollowing out. And Washington was furious. So in 1985, the finance ministers of the world's 5 richest nations met at New York's Plaza Hotel and made a deal. The Plaza Accord. They would deliberately weaken the dollar and strengthen the yen. Almost overnight, the yen surged from 240 to the dollar to 200. Within 3 years, it hit 120. For Japanese exporters, this was a disaster. Their products became expensive. Sales tanked. Profits collapsed. So Japan's central bank panicked and slashed interest rates from 5% to 2.5%. The government pumped stimulus into the economy. The goal was simple: keep growth alive. But what happened instead was complete financial insanity. With money cheap and flooding the system, asset prices went vertical. Stocks tripled in 4 years. Real estate in Tokyo skyrocketed to levels 350 times higher than Manhattan. Banks started lending recklessly to anyone with a pulse. Companies stopped caring about making actual products and instead gambled on stocks, a practice called Zaytech or financial engineering. Nissan had entire divisions dedicated not to building cars, but to trading stocks. Toyota wasn't selling vehicles, it was playing the market. One survey found that between 40 and 50% of corporate profits came from speculation, not operations. Japanese companies went on a global shopping spree. Mitsubishi bought Rockefeller Center for $1.4 billion. A businessman paid $82.5 million for a single Van Gogh painting. Golf memberships sold for $2 to $3 million. The world watched in awe. And everyone believed it would last forever. In late 1989, institutional investors were surveyed about the stock market. Most didn't think it was overvalued. The myth of Japanese exceptionalism was gospel. Land prices can't fall in Japan. There's too little land. Too much demand. It's different here. Except it wasn't. In 1989, policymakers looked at the insanity and realized they'd lost control. So the Bank of Japan slammed the brakes. They raised interest rates from 2.5% to 6% in less than a year. The bubble didn't deflate. It detonated. The Nikkei crashed from 39,000 to 20,000 within months. By 1992, it was at 15,000. Commercial real estate collapsed by 50%. By 2004, Tokyo residential property had fallen to 10% of its 1989 peak. The most expensive land in Ginza was trading at 1% of its bubble value. Banks that had lent trillions against overvalued real estate were suddenly holding worthless paper. Companies that borrowed to speculate saw their balance sheets implode. The entire financial system froze. And that's when the debt story really begins. When the bubble burst, Japan's government faced a choice. Let the system collapse. Force bad banks to fail. Let zombie companies die. Accept a brutal recession and restructure the economy. Creative destruction. Or step in. Bail everyone out. Keep the system alive. Prevent total meltdown. They chose option 2. And they've been paying for it ever since. Instead of forcing banks to write off bad loans, regulators let them pretend everything was fine. Loans were restructured. Accounting standards were loosened. The hope was that if everyone just waited long enough, asset prices would recover and the problem would solve itself. They were catastrophically wrong. What emerged was something economists would later call zombie lending. Banks kept funneling money to insolvent companies, firms that literally couldn't cover their interest payments, just to keep them breathing. These zombie companies didn't innovate. They didn't grow. They just existed. And they poisoned the entire economy. They undercut prices to stay competitive, crushing profits for healthy companies. They hoarded workers, preventing labor from flowing to productive sectors. They occupied market space that could have gone to startups. Research shows that zombie firms destroyed job creation, killed productivity, and strangled economic dynamism. Instead of a recovery, Japan entered what would become known as the lost decade. Later extended to the lost decades. Plural. Real GDP growth, which had averaged 4 to 5% in the 1980s, collapsed to less than 1% per year from 1991 to 2003. Worse, the country slipped into deflation. Prices started falling. And in deflation, cash becomes more valuable over time. Why spend money today when it'll be cheaper tomorrow? Why invest when returns are negative? Why borrow when debt gets more expensive in real terms? The entire economy froze. Companies stopped investing. Consumers stopped spending. Banks stopped lending. And to keep things from imploding entirely, the government kept spending. Public works projects, bank bailouts, corporate subsidies, stimulus packages. Every time the economy wobbled, the government opened the fiscal floodgates. And so the debt began to climb. In 1990, Japan's government debt was a perfectly manageable 60% of GDP. By 2000, it had doubled to 120%. By 2010, it was 190%. Today it's 237%. That's over $13 trillion. Second only to the US and China in absolute terms. But unlike them, Japan's economy is much, much smaller. Here's where things stop making sense. By every conventional rule of economics, Japan should have hit a debt crisis years ago. When Greece's debt hit 180% of GDP, bond yields spiked, investors fled, and the country needed multiple international bailouts. When Italy's debt climbed toward 140%, markets panicked and the Eurozone nearly collapsed. But in Japan, 10-year government bond yields have been near zero for decades. As of 2024, they're still under 1%. The Japanese government borrows money cheaper than almost any other country on earth. So what makes Japan different? First, who owns the debt? Unlike Greece or Italy, which relied on foreign investors, Japan's debt is almost entirely held domestically. About 88% of Japanese government bonds are owned by Japanese institutions. The biggest holder? The Bank of Japan itself, which owns roughly 46% of all government debt. Insurance companies hold another 15.6%. Banks hold 14.5%. Foreigners? Less than 8%. This matters enormously. When your debt is held by foreigners, you're vulnerable. If investors lose confidence, they dump your bonds, drive up interest rates, and trigger a crisis. But when your debt is held by your own central bank and domestic institutions, there's no one to panic. The Bank of Japan isn't going to suddenly decide Japanese bonds are too risky. Domestic pension funds aren't going to flee. Japan essentially owes money to itself. And when you owe money to yourself, the rules change. Second, Japan prints the yen. This is absolutely critical. Japan issues debt in its own currency, which it controls. Unlike Greece, which uses the euro and can't print money, Japan can always create yen to pay its debts. Does this mean Japan can print unlimited money? No. Hyperinflation is real. But it does mean that outright default, the kind of sovereign bankruptcy that destroyed Argentina or Greece, is essentially impossible. The worst-case scenario isn't default. It's inflation. And for a country that's been fighting deflation for 30 years, A little inflation would actually be welcome. Third, the interest rate trap. Here's the most fascinating part. Japan's debt is only sustainable because interest rates are near zero. The government pays shockingly little to service its debt, around 1.1% of GDP in interest costs. Compare that to 3.2% in the United States, 3.9% in Italy. How is this possible? Because the Bank of Japan keeps rates artificially low by buying massive quantities of government bonds. This is called yield curve control. The central bank sets a ceiling on long-term interest rates by committing to buy as many bonds as necessary. As of 2024, the Bank of Japan owns over 52% of all domestic government bonds. It's the largest buyer in the market. And its purchases keep interest rates suppressed. But here's the trap. If the Bank of Japan ever stops buying, interest rates will rise. If interest rates rise even slightly, the cost of servicing Japan's debt will explode. Let's run the numbers. If Japan's average borrowing cost increased by just 1 percentage point, from 0.5% to 1.5%, the additional annual interest expense would be roughly 13 trillion yen. That's about 2.5% of GDP. More than Japan's entire defense budget. Nearly half of what the government collects in consumption taxes. Now imagine rates rising to 3% or 4%, normal levels for most developed economies. Japan's interest costs would consume 6 to 8% of GDP. The government would face impossible choices: cut pensions/healthcare, raise taxes to crushing levels, or print even more money. Any of those options could trigger a recession. And in a recession, tax revenues fall, deficits widen, and the debt gets worse. So the Bank of Japan is stuck. It can't exit its bond buying program without risking a crisis. It's caught in a feedback loop of its own making, a trap that becomes more inescapable with every bond purchase, every year of near zero rates, every trillion yen added to the pile. Fourth, Japan is still rich. Despite decades of stagnation, Japan remains the world's third largest economy. Its citizens enjoy high living standards, world-class infrastructure, and some of the longest life expectancies on Earth. The country runs a trade surplus and holds over $3 trillion in foreign assets, making it the world's largest creditor nation. Japan isn't poor. It's rich but trapped in a low-growth, deflationary equilibrium. And as long as domestic savers keep buying government bonds at near-zero yields, the system can limp along indefinitely. In 2012, a new prime minister took office with a radical plan to break Japan out of the trap. Shinzo Abe, Japan's longest-serving prime minister, launched an economic program that would become known as Abenomics. The plan had 3 arrows. Arrow 1, aggressive monetary policy. The Bank of Japan would implement massive quantitative easing, buying government bonds, crushing interest rates, and flooding the economy with money. The goal? Generate 2% inflation and break the deflationary mindset. In April 2013, the BOJ announced it would double the monetary base by buying 60 yen to 70 trillion yen in bonds annually. By 2014, that figure had grown to 80 trillion yen. The central bank's balance sheet exploded to over 100% of GDP, far larger than the Federal Reserve's at the height of the 2008 crisis. Arrow 2, fiscal stimulus. The government would spend aggressively on infrastructure, disaster preparedness, and public works. In 2013 alone, Abe's government announced over 20 trillion yen in stimulus, one of the largest packages in Japanese history. Roads, bridges, tunnels, earthquake-resistant infrastructure. The spending was relentless. But there was a catch. To fund Social Security, Abe raised the consumption tax from 5% to 8% in April 2014. This created a bizarre contradiction, stimulating the economy with one hand while taxing consumption with the other. The result? The economy contracted. The recovery stalled. And the government responded with more stimulus spending. Arrow 3, structural reforms. This was supposed to be the game changer. Deregulate labor markets. Encourage entrepreneurship. Increase women's workforce participation. Open the economy to competition. This was the arrow that would deliver long-term growth. This was the one that would fix Japan's demographic and productivity problems. It never really happened. Structural reforms are painful. They threaten powerful interest groups, corporations that benefit from protection, unions that fear labor flexibility, rural constituencies dependent on subsidies. Abe talked a lot about the third arrow. But political realities meant it fizzled out. So what did Abenomics achieve? The stock market rallied. The yen weakened, helping exporters. Deflation slowed. For the first time in years, inflation ticked upward, though it never consistently hit the 2% target. But GDP growth remained tepid, averaging around 1% annually. Productivity growth was anemic. Wages stagnated. And most critically, government debt kept climbing. By 2020, when Abe resigned due to health issues, Japan's debt had swelled past 230% of GDP. Abenomics didn't break the trap. It just made the trap more comfortable. Here's the cruel irony. Japan's debt isn't sustainable in the long run, but trying to fix it could trigger the crisis it's meant to avoid. The demographic time bomb. Japan's population is shrinking and aging rapidly. In 2024, nearly 30% of the population is over 65. The birth rate is well below replacement level. By 2050, the population is projected to fall from 125 million to under 100 million. Fewer workers mean less tax revenue. More retirees mean higher social security and healthcare costs. The fiscal equation is getting worse every single year. Historically, Japan's high domestic savings rate made it possible to borrow domestically at low rates. But as the population ages, household savings are declining. Retirees spend their savings rather than lend them to the government. Insurance companies and pension funds facing long-term liabilities are becoming less willing to hold low-yield government bonds. If domestic demand for Japanese government bonds weakens, the government will have to rely more on foreign investors. And foreign investors will demand higher interest rates. The inflation dilemma. For 30 years, Japan fought deflation. Now, ironically, global inflation has finally pushed prices up. In 2024, Japan's inflation exceeded 2% for the first time in decades, driven largely by rising energy and food prices. You'd think this would be good news. Inflation erodes the real value of debt. But it's a double-edged sword. If inflation becomes entrenched, the Bank of Japan will face pressure to raise interest rates. And higher interest rates mean higher debt servicing costs. Japan is trapped between two terrible options: keep rates low and risk runaway inflation, or raise rates and risk a debt spiral. The Bank of Japan's exit problem. As of 2024, the BOJ owns over 52% of all government bonds. Its balance sheet is enormous. But central banks can't buy bonds forever. At some point they need to normalize policy. But how do you unwind a position this massive without crashing the bond market? If the BOJ stops buying, or worse starts selling, bond prices will fall and yields will spike. The government's borrowing costs would explode. Financial institutions holding large quantities of government bonds would see their portfolios crater. Banks would face losses. The economy could tip into recession. The Bank of Japan is stuck holding a financial weapon that it can't put down without blowing up the economy. So why hasn't Japan collapsed? Why does the system keep functioning despite all these warning signs? The closed loop. Japan's debt machine works because it's a closed system. The government borrows from the Bank of Japan. The Bank of Japan pays interest back to the government through profit transfers. Domestic savers, conditioned by decades of deflation, accept near-zero returns. Banks and insurance companies keep buying government bonds because they have limited alternatives. It's a circular flow of money that never really leaves the country. As long as everyone stays in the loop, the system is stable. Cultural patience. Japanese savers exhibit what economists call home bias, a strong preference for domestic assets. Even with near-zero returns, Japanese households keep half their wealth in low-return bank deposits. This isn't economically rational, but it's culturally embedded. Some economists argue it's even patriotic, Japanese citizens buying government bonds to support their country. Whether that's true or not, the result is the same: a captive domestic audience willing to lend to the government at rates no rational foreign investor would accept. The dollar safety net. Japan holds over $3 trillion in foreign assets, including massive holdings of U.S. Treasury bonds. If needed, the government could liquidate some of these assets to create liquidity or stabilize markets. This safety net gives bond investors confidence that Japan has options. The absence of alternatives. Where else would Japanese savers put their money? The stock market is volatile. Real estate burned them in the 1990s. Foreign assets carry currency risk. Domestic government bonds, despite low yields, are seen as the safest option. As long as there's no better alternative, demand for Japanese government bonds will persist. Can this last forever? Almost certainly not. But predicting when and how it ends is extraordinarily difficult. Here are the scenarios. The soft landing, the optimistic scenario. Japan slowly grows its way out of the trap. Productivity improves. Inflation stabilizes at 2%. Nominal GDP grows faster than debt. Over decades, the debt-to-GDP ratio gradually falls. The Bank of Japan carefully unwinds its holdings without triggering a crisis. This is what policymakers hope for. It's also the least likely scenario, given Japan's demographics and structural challenges. The inflation escape, the realistic scenario. Inflation runs higher than expected, say 3 to 4% annually. This erodes the real value of debt faster than new debt accumulates. The government doesn't explicitly default, but bondholders effectively take a haircut through currency depreciation and negative real returns. This is painful for savers and pensioners but manageable for the government. It's a quiet form of debt restructuring. The zombie permanence, the status quo. Nothing changes. Japan continues to muddle through with low growth, low inflation and low interest rates. The debt keeps climbing, but so does the Bank of Japan's balance sheet. The system becomes permanently stuck in a low equilibrium trap. This is arguably what's already happening. Japan doesn't collapse, but it never really thrives either. The crisis, the pessimistic scenario. A shock, demographic collapse, a financial crisis, a geopolitical disaster, breaks the loop. Domestic savings dry up. Foreign investors lose confidence. Bond yields spike. The Bank of Japan can't control rates anymore. Debt servicing costs explode. The government faces a choice: default, hyperinflate, or slash spending and trigger a depression. This is the nightmare scenario. And while it hasn't happened yet, the longer the debt grows, the more fragile the system becomes. Here's what makes Japan's debt paradox so fascinating. It's proof that conventional economic rules don't always apply, until suddenly they do. For decades, economists warned that Japan's debt was unsustainable. They predicted crises that never came. They pointed to fiscal rules and thresholds that Japan blew through without consequence. And they were right to worry. Japan's debt is unsustainable in the long run. But the long run is longer than anyone expected. Because Japan has unique advantages: domestic ownership, monetary sovereignty, a closed financial system, and a population willing to accept financial repression. Other countries tried to replicate this model and failed spectacularly. Argentina, Turkey, Venezuela. They all tried to finance large deficits with central bank bond purchases. But they didn't have Japan's credibility, domestic savings, or institutional discipline. They ended up with hyperinflation and collapse. Japan works because of a specific combination of factors that may never be replicated elsewhere. It's not a model. It's an anomaly. But even anomalies have limits. Japan's debt story is not a tale of fiscal irresponsibility. It's a story about how a spectacular economic boom created an equally spectacular bust, and how a government chose to manage that bust by absorbing the losses onto its own balance sheet. In the 1990s, Japan could have let banks fail, companies collapse, and the economy restructure violently. Instead, they chose stability over efficiency, survival over growth. They built a system where the government acts as the shock absorber, borrowing endlessly to keep the machine running. And it worked, sort of. Japan didn't have a Great Depression. Unemployment stayed relatively low. Social cohesion held. But the cost was stagnation. 3 decades of low growth, zombie companies, and a debt burden that hangs over the economy like a sword of Damocles. The real question isn't whether Japan's debt is sustainable. It's what Japan is willing to sacrifice to keep it sustainable. So far, the answer is growth, dynamism, and any real hope of long-term prosperity. But as long as the trains run on time, the economy doesn't collapse, and the alternative looks scarier than the status quo, Japan will keep doing what it's been doing. Borrowing, printing, waiting, and hoping that somewhere, somehow, there's an exit from the trap they've built. Because one thing is certain: debt this large doesn't disappear. It either gets inflated away, restructured, or it detonates. Japan is betting on the first option. We're all watching to see if they're right. If this deep dive into one of the strangest economic experiments in modern history blew your mind, hit that like button and subscribe. We break down the most complex economic stories in ways that actually make sense. Drop a comment and tell me, do you think Japan's strategy will work long-term, or are they heading for an inevitable crisis? Thanks for watching. I'll see you in the next one.